Hello, we're live and welcome to Property. A little bit late there. I did start thinking that I'd already clicked to go live, but obviously I hadn't. So here we go. So today I'm going to be joined by Greg Cunnington, and we're going to talk all things mortgages. The mortgage market is at the center of everyone's attention at the moment because it's given us all a crazy busy January. So I'm going to introduce Greg. So welcome, Greg. I'll put it on a better screen so we can see you a bit better.
Morning, Joe.
How are you doing? You well?
Yeah, good. Busy, which is a good thing to say, isn't it? How about yourself?
Yeah, not bad. I mean, I had our numbers through for January, and I mean, it could have been August or it could have been March. I can't believe that January is finished so strong. It's phenomenal.
Yeah, ditto. The change in sentiment is unbelievable, isn't it? We've had two of our highest performing weeks in several months, but I think most importantly, there's been a real uptick in purchase activity, and I think that's what we've all been missing for quite a while now. So it's been good times.
Yeah, I was speaking to someone yesterday, and they said that Rightmove stats have suggested that there are a lot more properties that have come on the market, but that's equally being met by buyers that are looking to buy. So it's not as if there's a glut of property that are coming on and there's no one looking to buy them, and so prices wobble. The properties that are coming on are very much being welcomed with open arms by buyers that have been sitting and waiting.
Yeah, exactly that. We've even seen a couple of sealed bids in the last 2 weeks, which is a phrase we've not heard in a while. I know it goes back, doesn't it? But it's not a massive shock, though. We saw a lot of people last year who wanted to discuss their options, but not actually even go and view because they were waiting for the new year to see where rates were. And I think also what we've got to remember is we're still going through the rate shock period where people's remortgage has gone from 1% to 4%, 5%, 6%. And we found a lot of those buyers, even if they wanted to move because of their personal life situations, whether it's needing more floor space, another kid, death, marriage, divorce, etc. When your mortgage is going up by £1,000 a month, you don't really want to add additional borrowing and do the big move. But what we found is now people have been 6 months, a year into the higher interest rates, and now mortgage rates have softened from maybe a 5% to something before at the beginning. A lot of those same people who refinanced in the last 12 months are now coming back and going, actually, we did always need to move. We just needed to make sure things were affordable. We're feeling more comfortable and confident that that is the case. What are my options? So I think we'll see a lot more of those buyers this year as well.
Yeah, I've noticed it as well in the car market. So I've seen that quite a lot of the car prices now are really tanking. So cars that were sort of like a premium, so like your Porsche 911, GT3s, things like that. Just, not that I want one, but kids still you can't help but watch them on YouTube, can you? Because it's their amazing piece of kit.
It's funny you mentioned that. Genuinely had a meeting yesterday because we've had 3 clients in the last week ask if we do classic car finance, and we don't. We never have done, but we did sit there and go, there's a bit of a theme here. Is this something we should look into? Unfortunately, I don't think we are because it's too different in terms of business type regulation, but it would have been fun.
Well, if they want an old school Land Rover Defender, send them my way.
Can they get insured?
Yeah, I'm digressing away. But no, it's just interesting how, like, obviously then the rates that are being charged in the car market is up at 8-9%, whereas mortgage rates are down at 3.5%. And you're seeing car prices drop, but actually house prices are kicking on. Yeah. So before we get into the nitty gritty, please could you sort of introduce yourself to the audience, let everybody know who you are, what you do. We all know you're a legend. My view on Greg is that he's like the Harry Kane of the mortgage industry, except he's actually won awards.
Thank you, Joe. And being a Tottenham season ticket holder, I don't mind you taking the mickey out of Harry Kane anymore. So he's old news, and good we won last night. Cheers, Joe. I'll take legend all day long. Obviously, good for the ego speaking to you, and you are as well, of course. But so Greg Cunnington, I'm the Chief Operating Officer at a mortgage intermediary called LDN Finance. We predominantly work in London and the South East. We've got just over 40 headcount, 23 advisors, and we kind of do every type of finance. So the majority is residential mortgages, so first-time buyers, home movers, buy-to-let, landlords and investors. But we also do quite a lot of specialist lending. So we do bridging, commercial development finance. And we also have a private client arm. So we have 5 advisors who specialize in kind of private banks and high net worth lending. And in a previous life, I worked for 17 years at a mortgage intermediary called Alexander Hall. I was one of the directors. which is part of Foxton's group. So did basically every role and managerial role under the sun there, including a mortgage advisor for the whole period, which has always been my first and primary love. But yeah, so very much dealt in the estate agency and residential mortgage world there.
Brilliant. So I'm sure that when you were doing your GCSEs or your A levels, you weren't sat in maths thinking, "Oh, great, I can be a mortgage advisor. This sounds like great." How did you fall into the mortgage space?
Yeah, definitely not. I don't think we've ever met one person who had that thought process, have we? And to be honest, if I met a 13-year-old now who wanted to go in the industry, I'd think that was a bit strange. Although I agree it's a great thing to do and we should promote it more, I generally believe. But no, it was as simple as Joe, the old classic of did a degree in history because I was good at it, and then got into my third year and went, I don't have a clue what I want to do for a job. Everybody else I'm with seems to know exactly what they're doing and have a plan. Went online, looked for a graduate scheme, wanted to move back to London, originally from here, moved to Yorkshire. Alexander Hall, they still do it to this day, have a graduate scheme. They're very, very good at training and promoting and bringing people into the industry. So just went there as a 21-year-old because I was attracted to the idea of wearing a suit and getting given a company laptop. And then genuinely, within a few months, had fallen in love with it, which is very strange when you talk to people not in the industry. My wife still thinks it's very odd introducing me to friends when I say I love my job. But I have absolutely loved it since day one and never looked back.
Yeah, I mean, Foxtons have got an amazing training academy. The amount of people that they take in who are green, never been in the property sector before, and they roll out some of the people who are top of our industry now. If you look in any boardroom, there's probably someone from Foxtons that's come through that academy, and I seem just feel like the work ethic. There's something special that's in that training academy that seems to just bring out some superstars.
Yeah, 100%. The amount of people I worked with, both at Alexander and Foxtons, who to this day I consider very good friends. And as you say, we've got mutual contacts from Foxtons who now are chief executives, etc., other big agencies in the industry. And then likewise, if you look at the London mortgage intermediaries, about half are run by ex-Alexander Hall employees, was it myself and LDN included. So it just shows how strong the training ground is. And I believe that is still the case. I think it's a fantastic training program there. So great business.
Yeah, really good. So obviously then if we go through into the mortgage market. So in simple terms, so obviously there'll be lots of people who will know what goes on in the mortgage market, but we will have people who maybe are green estate agents new to the market, like we're just explaining, lots of surveyors. I obviously work in the mortgage market more so in the past than I do today within doing mortgage valuations. So you understand from a surveying perspective how to value property and what properties lenders are looking for. But I think that we should colour in the picture a little bit for people of what is a mortgage and how are rates assessed. How does it link with the bond market and the yield markets, just to try to set the scene a bit, if that's okay?
Yeah, of course. It's a great question. Obviously, one we get asked all the time, especially at the moment, because if you take a step back and go just very, very high level, you've got a base rate that's been stable for a few months now at 5.25%. And yet, as we all know, you can get a 5-year fixed rate mortgage in the low 4s. So you would obviously look at that and go, well, I know interest rates and mortgages correlate. So why is a mortgage cheaper than base rate? That's a bit confusing. And the reality is it's because nearly all mortgages are funded over a longer term period. So whether that's 2 years, 3 years, 5 years. And then remember, a mortgage typically will be 25, 30, 35 years. So what happens is lenders, using different means, banks and building societies will normally do a combination of using their own deposit funds and hedging against the markets. There are other lenders who securitize, so they literally buy the money from the markets and then try and sell their mortgage books on. But what it does mean is mortgage pricing is often linked to market sentiment of where interest rates will be going. And that's done in a couple of ways. One, as you say, is bonds and gilts. So if you see if they're going up or down, that can normally give you a good correlation on where mortgages will go. And the other one, which is probably a phrase everyone's heard of in the last 6 months and never heard of in the history before, is swap rates, which is what every mortgage broker, it's almost their every other word nowadays. But swap rates is the market where 2-year, 3-year, 5-year, 10-year money is kind of priced forecast. And although it's not an exact science, a lot of mortgage lenders do buy their money based on swap rates, which they then pass on as mortgages. And if you look at current swap rates, they've actually gone up a bit in the last month or so. They were on a downward trajectory, but still a 5-year is looking at about 3.7, a 2-year at about 4.2. So when you think base rates at 5.25, obviously that's why mortgage rates tend to be lower, because lenders are looking at the swap rates and where the pricing is going.
So is that because they think that interest rates are likely to come down soon?
Correct, exactly. And that's why I think we've seen swap rates creep up in the last month as well, because there was an idea coming out that with inflation actually coming down quite quickly, maybe a base rate decrease would come even sooner. Maybe even I heard some people say March. Whereas I think now with the inflation data being not quite as positive last month, although if you look at it, it was only 0.1 higher, and I think the majority of that was due to smoking of all things. But it shows that smoking has caused increase in mortgage rates.
Everyone's stressed out now. They're just going back to ciggies.
Exactly right. So exactly that. So there's a feeling that interest rates will be coming down, and then it's always a bit of a guessing game as to when and then how quickly. Even obviously the Fed kept things on hold this morning, last night, when people thought that may come down. People were saying March, they're saying now probably May. And it tends to be the US has been a few months ahead of us in most of this curve in both of interest rates and inflation. They went quicker, faster, meaning they should be able to come down quicker. But I think now there's a sentiment where if the Fed's not going to reduce rates until May, we're probably not going to do it until later this year as well.
Yeah, I did a podcast with Simon Rubinson, who's the chief economist at the RICS, and he was explaining that Christine Lagarde over in the ECB had said don't expect rates to come down fast, but they didn't raise their rates in the same way that we did. They were a lot slower, so I wasn't too sure whether that comment is really relevant to us, because they didn't accelerate at such a pace.
No, exactly. They did it earlier and more controlled as well. And so I think, although we will see similarities, that the Fed, the ECB and the UK will probably all start reducing interest rates within a few months of each other. No, I wouldn't say it's identical circumstances. And also I do think it's a strange one, isn't it? Because if you look at the last MPC meeting, 3 of the members actually still voted for a base rate increase. So I sometimes wonder what the Bank of England is seeing and doing that the rest of us can't see, because with my GCSE A-level economics, I do look at it and go, I think they should come down already, to be really honest. I don't think that will happen. I'm certain they'll remain where they are for a few months. But if you look, you don't want to really risk recession. So I think once the data comes in the coming months, we will see rates come down this year.
Yeah, I think it's when I use, obviously in university, I studied economics as part of my my real estate degree, and the reason why inflation is here is because all of the governments across the world printed loads of cash. So there's loads of cash that has been printed. So obviously that's going to inflate the price of everything. And obviously there were issues with moving goods across the world, oil issues. There's what's going on in Russia. It wasn't because we're all spending too much money, which is causing the price of everything to go up. So it felt a little bit strange in a way that everybody raced on and increased interest rates when the problem, it wasn't us spending money that was the problem.
Agreed. It was a very obvious, unique set of circumstances, which I thought everybody was aware of. And you mentioned a couple of things. The issue is what we did learn from the whole period is forecasting is very, very difficult. The amount of some of the top economists in the industry I met last year who what they said in July was completely different to what they'd said 5 months earlier in kind of January, February. And we're seeing it again this year where lenders are forecasting where they think gross mortgage lending will be for the year. And it's quite conservative. But when I think about it, I suppose they have to be that way because they got it so wrong several times last year and had to keep going back to Treasury and go, actually, it's going to be 20 billion lower, 30 billion lower. But I personally think it's going to be higher than everybody's forecasting this year, especially from what we saw in January.
Yeah, as long as there's not some crazy world event that all of a sudden grinds us all to a halt.
Yeah, and obviously an election in theory could be a big pause button, but you know, I think it looks so certain what the next government will be. That may not be as big a pause as people feared because actually it's pretty consistent with where we are now, unless there are big changes before then.
Yeah, there are more elections this year. I think there's over 50 elections this year. More than half of the population are going to vote this year across the whole world. It's not just us; it's everywhere. In history, there has never been so many elections. So, if you were the ECB puppet master, or if you were controlling a one world government, this is a good opportunity to get some control this year. But that's another story, probably for another channel somewhere else.
Yeah, it could be a fun one, man.
So we had a couple of comments coming in. Rates are key, although lenders are dropping, but Bank of England doesn't start really dropping rates. They're going to keep on dropping rates soon. But my sort of question, looking at what Oasis is saying, is because rates are where they are when interest rates are at 5.25%, if the Bank of England do drop down to 5 or 4.75, the mortgage prices today are pretty cheap, right? So do you think that they will drop down at a similar rate?
I think they will, although it's already kind of baked in. I think once we see one base rate decrease, it's going to make the markets realize there'll be more coming in the next 12 months. So I think we'll see mortgage pricing and swap rates decrease then. However, to play almost devil's advocate myself, what we are seeing is we're now seeing mortgage rates creep up slightly from the real lows we saw at the beginning of this month. So I actually think we may have had the cheapest mortgages for a period 2 weeks ago. We're probably going to have 2 or 3 months where they remain quite static now, or maybe creep up a bit, unfortunately. But then, yes, I think once we get the signal that base rates going down, we'll see mortgage rates come down again then.
Yeah, I kind of had that same feeling that maybe a couple of weeks ago was the sweet spot. But mortgage rate wars. So obviously we can see now that lenders are dropping. I saw a couple reprice at extra 0.3%. You call that 30 basis points, right, in the market?
Yeah.
Oh, check me out. The lingo. But you can see them edging up a little bit. But are there any lenders that you think that have got a really big appetite to do business at the moment?
Oh, yeah.
Challenging one another.
Yeah, it's actually been one of the best points of this year. In fact, I'm looking at our office and I can see Barclays and Halifax both in SAT trying to get business out of the advisors, which is always a good sign. I think the reality is, if you think we had the artificial market during COVID times, but gross mortgage lending went up to around 300 billion for 2 years. They're forecasting this year by IMLO it will be about 210, 215 billion. But your big lenders still want their share of that pie. So what we're seeing is they've got a huge appetite, which is manifesting in 2 ways. One is rate wars, as you mentioned. And I think part of the low mortgage rates we saw was lender pressure and competition. In fact, we had some of the building societies in whose obviously models are based on mortgages and margin, looking at it and saying, a couple of these big lenders, there's no way they're making profit. They're clearly getting mortgages out just to keep their lending targets up and sacrificing making any profit at all for that period, which is great for consumers and obviously helps explain why rates were low. But also, once you get to that stage, there's nowhere further you can go. Lenders can't make huge losses on their lending. So the only other lever they have is criteria. And one thing we've seen this year, which has been really positive and definitely positive for any estate agents on the meeting, is lenders are doing some criteria moves, which we've been asking for 2 or 3 years and customers have been needing. And we've been told risk says it's a big firm no, and suddenly it's a yes. So good examples would be, we've got one lender yesterday who for professionals will now lend 6 times income again when it was at 5. There's 2 more lenders who will now do 75% of bonus income, but we're at 50. And these are kind of niche lenders, like 20 to 40 of largest, but still very, very good lenders and good options. And the other really positive one is, and I'm sure you've heard this from a lot of applicants and buyers in the last year, lenders' affordability models were really difficult to get past. So whereas before you'd hear 4.5 times income, 5 times income, 5.5 times income, and with interest rates so low, as long as you're on a goodish income, you could get that number. What we found is now lenders are having to stress at their SVR plus another number. So they're pretending the mortgage in effect is 8, 9, 10%. We had some clients who, if the kids were at private school and they had a car on a lease, they were getting 3.5 times income, which was stopping them moving even if it was affordable. What we found this year is now lenders are confident rates are staying where they are going down. They're loosening affordability calculations and getting to that 4.5 times income, 5 times is looking possible again. And I think we'll see that trend really continue, which is very needed.
So I suppose advice then to people who maybe, I can't remember the statistic that I saw of people who are coming up to remortgage time that are obviously going to have that shock where they've been on 1.89% and they're about to see 4% or whatever they may be seeing in a remortgage. it's probably a good opportunity for them to come forward and maybe look to remortgage early if rates are where they are today. Do you think? What advice would you give to someone in that situation?
Yeah, definitely. And what I would say is typically most lenders now would allow you to fix in up to 6 months before the end of your expiry date. And one positive of this situation is that used to be if you change lender, but your existing lender would normally say it needs to be within 3 months. But the government enforced a mortgage charter last year, which most of the big 20 lenders have signed up to, which means they have to offer up to 6 months in advance. The other real positive of mortgage charter is if a better rate becomes available in that period, then they have to let you move to that with no penalty. So what we're seeing is because there are typically no fees with remortgaging, most of the big lenders pay for your solicitors and the valuation. There is literally nothing to lose in locking in as early as you can. If rates do indeed creep up, you've got that locked in guaranteed. If rates come down, you just switch it and decrease. And in fact, if there's any other brokers or intermediaries on the call or listening, they'll be smiling because the hardest part of our job for the last 6 months has been the admin and paperwork and resource with moving people to lower rates as they become available. Because we don't just press a button and switch it. We have to do the advice process again. So look over the file, get the updated client information, do another suitability report, send you illustrations, etc. But it's the right thing to do. And we've got some clients we've moved rates 5 times for because rates have kept getting lower. So yeah, anybody coming up to remortgage, my advice is to speak to an intermediary as early as possible at that 6-month window.
Yeah, I think it's the value of a broker, I suppose, which we should move on to. I was going to go on to that in a bit, but like I know that ever since I met my wife, she loves Lloyd's Banking Group. She just loves Lloyd's. They really helped her out when she was in university, and so she has that real brand loyalty where she loves them. She's great, and you know, she still has her bank account with Lloyd's now. I don't bank with Lloyd's, but she does. So some people will just walk into their trusted building society or bank, and they will get their mortgage through that lender because that's where they feel as though that's their bank, right? Yeah. So why should someone like that go to a mortgage broker to get their mortgage, and should they come and have a conversation to see what their options are?
Yeah, definitely. And I think it's twofold. One is the rate piece. So every lender has different targets, volumes, appetite at any moment in time. So and also we're seeing rates reprice every 2 or 3 days. So you just have no idea if you're getting the best product or not. So it might be one day Lloyd's Banking Group have the best rate. And if you hit that sweet spot, fantastic. But there's a genuine good chance there are 15 lenders with cheaper mortgage rates. And sometimes the difference can be up to 1%. So if you're fixing in for 5 years up to 1% higher just because you didn't look at the whole market, you know, it's probably your largest financial commitment that you have. So that side of things for me is just absolutely bonkers. And it does literally change weekly who will be the most competitive. There's never one lender who's just always market leading. It really does swap out. And the second is the criteria piece, particularly if somebody's needing to max affordability or move house. Not many clients have a really clean scenario now. So there aren't many people who just need 3 times salary, have no loans, no credit commitments, no kids, no car leases. Most people have something, and they tend to have bonus or overtime or vested stock or other assets, etc., and various commitments. And when we run those through the affordability calculators, because every lender's criteria is so different, the difference in borrowing can be hundreds and hundreds of thousands of pounds. So a good example would be, let's say you've got an estate agent on a basic of £20,000, but they earn 80k OTE. So their P60 shows £100,000. We have a couple of lenders who will take 100% of that income. So they can probably borrow about 450, 500,000. A couple of the top 6 lenders will cap their commission on their basic and take 50%. So they would cap the commission at 20, take 50%, so that's 10. So they'd say your income is 30, so they would lend that applicant 150,000. So if you walked into your bank, you're told you can get a mortgage of 150. If you go and speak to an intermediary, you're told you can get a mortgage of 500. But, you know, and that's a genuine, very easy example. But again, anybody with bonus, commission, credit commitments. We had an example with somebody who's very senior in the armed forces recently. They've got 1 kid at private school, 1 car on a car lease. One of the big 6 offered 400,000. One of the big 6 offered 800,000. Same client, same scenario, just with different calculations. And that's really accelerated. We've seen at IMLA, which is the Intermediary Mortgage Lender Association. So I think you know them well, Joe. They did some data, whereas 5 years ago, 75% of mortgages were done for a mortgage intermediary. Last year it was 87%, and they forecast this year it will be 89%. So I think that the public are beginning to realise that is the case, because that's 9 in every 10 mortgages are now done for an intermediary. And also you can see with banks closing branches, they're kind of wanting it to go that way. And we see, well, I can't name the names because it's not allowed, but a lot of the big top 10 lenders and big six, they now give exclusives to intermediaries. So not only can you get better criteria, you can often get a better rate as well, which is obviously very important.
Yeah, I saw Bank of Ireland have increased the fees that they're paying brokers to, I assume, either reward them properly for the work they're doing or to encourage them to send a bit more work their way.
Yeah, a bit of both. Never a bad thing to see.
Yeah. So I suppose as well, I think that so that sounds like there's a misconception then from people who might think that if they go to a mortgage broker, they've got to pay a mortgage broker. It's another person in the middle. Maybe it's more expensive to go through a mortgage broker, but it sounds like that's a total misconception then. If you're able to save people a lot of money by getting them a much better interest rate, maybe they can borrow a bit more money and then they can pay that car loan off that's on 8% APR. They can get that cost down. How does that work of fees? How does the broker get paid?
Yeah, exactly. And it's the whole advice piece you're getting as well, obviously. It's a professional service at the end of the day. And that's now I mentioned earlier, the client who did 5 rate changes. The rate they completed on was 1% lower than the rate they applied on, which in itself, I think, was a saving of about £20,000 in interest over the mortgage product. Brokers and their charges varies depending on brokerage. So there will always be a procuration fee, a commission from the lender. That doesn't affect the price or pricing, it's baked in, but it will be disclosed to the client. And then every broker has a different model in relation to fee charging. So we charge typically a flat fee for residential mortgages, or it could be higher if it's a private bank case or an offshore client. That's not for the product, that's for the service. So it's done as a kind of professional service fee. And as I say, it's flat. Some firms are fee free. So you get some of the big kind of more tech-based firms who don't give us boutique or manual service proposition, but will still do a great job and get the product, won't charge a fee. And then some brokerage firms specialize in a really complex areas and may charge a higher fee. One good thing which came up last year in regulation from the FCA was something called consumer duty, which affected everybody in financial services. But part of it was something called a fair value assessment, where every mortgage intermediary had to confirm in writing their fee structure and why it represented fair value. And that's something we now go through with clients if we charge a fee in the first conversation with them as well.
Brilliant. Well, I'm conscious of time because we've been 28 minutes already. I can't believe it.
You know me, I'm talking about mortgages, Joe.
Yeah, exactly, mate. So I've seen there's a big shift in the professional market where you've got companies now that are trying to get people onto like a contractor basis rather than an employee. You can go and work for a company and then maybe you're on a 50-50 fee split. I've seen it a lot in the legal side of things. So rather than just being a high-paid lawyer, rather than setting up your own practice, you can just go and do a joint venture with someone. How do the mortgage markets see that?
It varies. It's if it's a partnership at a big structure, it can be really flexible. So if somebody goes from an employed role to a partnership self-employed role, but the firm have over typically 200 partners. So, you kind of PwCs, Deloitte, your big law firms. Mortgage lenders are brilliant there. Nearly all of them will take a letter from the partnership and work on that income. So there are a couple of banks who say you're self-employed, we need 2 years accounts, but just speak to an intermediary and all of us can ignore that completely. If it's somebody who is just going completely solo in certain fields, normally you will need 1 year's accounts figures. Often lenders will say on their website 2 or 3 years, but ignore that because by speaking to underwriters directly, we can use your track record and typically get 1. If it's contracting, so if it's actually more kind of day rate, weekly rate, even if you set up a limited company or you go for an umbrella scheme, there are lenders who can be really flexible there and use your track record. So one of the joys of where the market's gone is most lenders, because they're so hungry for business, they give intermediaries access to speak to the decision makers directly. So what we can now do is go, hi, lender X, here's my client, here's all their paperwork and documentation. Can you take a manual approach? I know it's a no through the tick box criteria on your website. So anybody in that scenario, my advice is just be transparent with how your situation looks, and there should be an option out there.
Lender X sounds like Elon Musk is entering the market.
Yeah, that could be fun. That could be really fun.
A final question then. So I've read quite recently up north I won't mention names, where estate agents again are insisting that they won't take an offer from you unless you use their in-house mortgage broker inside the estate agency, or they won't allow you to increase their offer unless you get financially qualified.
Yeah.
What would your advice be to someone that's in that situation where they're being pressured?
Yeah, it's not great. We saw more of it last year as well. I think as some estate agents were quieter on the sales side, obviously they were looking to pressure a bit more on the other commission basis. And I want to say is, first of all, I don't think there's anything wrong with estate agents recommending their in-house financial advisors. And some of them work for really good companies. Yeah. When I was at Alexander Hall, we worked closely with Foxtons and tried to speak to as many applicants as possible. But in that scenario, if you're the buyer, it's very important to know they cannot insist on that, and they really shouldn't. And what I would say is to say, can you just speak to my advisor directly? Because A, there may be a bit of a conflict of interest, but B, it's just, you're not allowed to do that. It's pressured selling and you really can't do things that way. And also some of these estate agency brokers for some of the bigger chains, those intermediaries work off smaller panels of maybe only 20 lenders, where we used 140 lenders last year, for example. So you may not be ensuring you get the best option for your circumstances. So my advice would be just to push back and say that is not allowed. It's not allowed. Can you speak to my broker directly? We would always be happy to chat to the agent and just appease them and let them know your proceedability. Yeah,
brilliant. Yeah. Wow. Well, we've been half an hour. That's blown me away. I haven't even got through half of my questions. So
sorry, Joe.
No, it's because it's all great. Good. It's all good stuff, right?
Absolutely. Really enjoyed it.
So great. Well, thank you very much for your time. Hopefully everyone in the audience, you've listened and understood a little bit more about the mortgage markets. Greg is at LDN Finance. So what's the best way to get in contact with you, Greg, if people would like to work with you?
If you just go on our website, ldnfinance.co.uk, there's an inquiries page, or if not, just email us at inquiries@ldnfinance.co.uk. We'd love to work with everyone and we'll get back to you ASAP.
Yeah, I think that for any surveyors that are out there as well, it shows the importance of working in a collaborative way. We are LDN Finance's preferred firm of surveyors, and Greg and I collaborate on any issues. So you had a case this morning which we were just chewing the cud over. Maybe worthwhile sort of explaining a little bit about how we can sort of add value to one another.
Yeah, absolutely. Obviously, we've always had a really close working relationship, Joe, haven't we? And I think, especially as lenders now more and more go down the AVM and desktop route, not having a good surveyor who can go into a physical survey on a property is insanity. So,
yeah, perfect. Okay, well, thanks very much for your time. Thanks everyone for watching, and we'll wait to see you on the next one.
Perfect. Thanks, everyone. Thanks for having me, Joe.